It is a great pleasure to welcome to European Investing Summit 2021, returning MOI Global Instructor, Marta Escribano. Marta is partner and principal analyst of Salmón Mundi Capital. She has been working in financial markets for about 15 years. She became principal analyst in 2013. Prior to that, she worked in the Treasury Department of Banco Popular at the FX and Fixed Income Desk. And before that, she had joined the Treasury of Inversis Bank and the International Equity Desk of Interdin as equity sales trader, advising mostly Swiss and Italian clients. Since the beginning of her professional career, Marta has been passionate about financial markets and the Austrian School of Economics. She holds a bachelor's degree in law from Universidad Pontificia Comillas and a master's degree in financial markets and alternative investments. Always a pleasure to have you with us, Marta. I really look forward to this in-depth presentation and will now turn it to you. Please go ahead.
Thank you. First, I want to thank Jan and Manual of Ideas for this opportunity, because it is a pleasure for us to take part in this summit. Before beginning with our investment case, let me give you a little insight of who we are. Salmon Mundi is a Spanish Sicav, which trades in the alternative exchange in Madrid. Our investment philosophy is based on two pillars. First of all, value investing and in the Austrian School of Economics. So we consider distortions caused by credit cycles and their impact on asset valuations. We invest all over the world, mainly in equities, both long and short, and we are interested in asset sectors or countries out of favor where little capital has been invested during long periods of time. We search for world-leading companies with unique assets, and we invest with a long-term horizon. Guillermo Nieto is partner and chief investment officer, and I am partner and the principal analyst, and you can find more information in our website, salmonmundi.com. So let's start with the investment case. Today, we want to present you British American Tobacco. And our investment thesis is that BAT is a unique company because it is the world's largest international tobacco firm by revenues and the second tobacco manufacturer. If we exclude China, British American Tobacco has around 22% global market share. The company has a very powerful cigarette business, owning 6 of the most sold brands worldwide, and is the leader of the tobacco industry in pricing power. It has a very good track record. It delivered 10% adjusted diluted EPS at constant rates CAGR over the last 10 years. And one key aspect of BAT's investment case is its exposure to the US market, which represents 51% of the company's EBIT. The US is a very attractive and profitable tobacco market, and US smokers have a high affordability. In our view, BAT is a defensive stock, which offers a strong cash flow visibility due to the company's solid market positioning, and also because of the high entry barriers and oligopolistic condition of the tobacco industry. Its valuation is also very attractive. The stock trades at 8.8 times its full year estimated earnings. And on top of that, it offers a 7.7% dividend yield. In fact, BAT is trading at the deepest discount versus the consumer staple sector in 20 years. Let's begin describing the company. British American Tobacco is the world's largest international tobacco company by revenues, and it has approximately 22% share of the global tobacco market excluding China. And if we focus on the top 40 tobacco markets, its share increases to 29%. The company was founded 120 years before. Its market cap is $86 billion, and it has more than 55,000 employees. It operates in more than 180 markets, including the US, which represents more than 50% of its EBIT. And if we take into account global industry's value, it represents a 40%. BAT owns many cigarette brands, including its strong global brands, Dunhill, Kent, or Lucky Strike. And to sum up, BAT is a global company with a multi-category strategy. Its business is divided into two main segments. The most relevant is the combustible portfolio, and on the other hand, the non-combustible portfolio. Philip Morris International and Altria have a larger market cap than BAT, but the following companies are much smaller, so BAT is one of the industry leaders. And if we take into account the market share excluding China, BAT is the second one. And if we focus on net income, BAT is the leading company of the sector. It's worth mentioning that this year, the billionaire Kenneth Dart has built a 7% stake in BAT through his Spring Mountain Investment Fund. He inherited the business family company, which is Dart Container, and is the world's leading manufacturer of styrofoam cups. He had a distressed debt fund, which used to buy debt in emerging markets, including Brazil and Argentina. And nowadays he owns several enterprises, and it is estimated that he is the owner of 25% of the total real estate in Cayman Island. The company's current management was appointed after Reynolds' acquisition. CEO was appointed in 2019 and chairman in 2021. Jacques Bowles is the CEO. He is French. He is 28 years old, and he joined the group in 2004. Looking at BAT's revenue by country, we can observe the high exposure the company has to the US market. And the next larger markets are Brazil and Japan, but they represent just 5% each of total revenues. Now let's talk about the products that BAT offers. They can be divided into two segments, the combustible portfolio and the non-combustible. Their core business remains cigarettes, which represented 88% of sales. And it is worth noting that BAT is the leading company in the industry in terms of pricing power. And as we will see later, volumes are decreasing, but higher prices more than offset lower volumes. For example, last year, BAT was able to raise cigarette prices by 7%, while volumes declined less than 5%. On the other hand, they have the high growth non-combustible portfolio, which represent almost 12% of sales. And it includes the traditional oral tobacco products and new categories. And historically, company's growth was driven by the huge pricing power in the combustible portfolio. The most important is the combustible portfolio, and nowadays cigarettes are still the company's main business. And more than half of total profits from operations comes from the US. And as you can see, Europe is the second largest market. Here we can see the good company's track record in organic revenue growth since 2010. And let's focus our attention on the most profitable business. Cigarettes represented 88% of 2020 sales. The company has strong global brands representing 50% of total cigarette sales. And BAT owns 6 of the best-selling cigarette brands worldwide, including the well-known brands Lucky Strike, Pall Mall, Dunhill, Kent, and Rothmans. After Reynolds' acquisition, they became owners of some US-specific brands, as is Newport, Camel, and Natural American Spirit. And BAT is succeeding in gaining market share in the US. And since 2017, it has gained 100 basis points. Here are the best-selling cigarette brands globally. And the ones in bold letters are BAT's brands. And it has 6 of the 13 most sold tobacco brands worldwide. BAT has global brands, 3 important US brands and local brands too. And here we can see how value for money brands, as can be Rothmans, are the brands which generate more revenues for the company. Revenues obtained from combustibles in 2020 fell 1% year on year. And if we exclude currency movements and adjusted items, they increased by 2.8%. BAT suffered 4.6% decline in cigarette volume since 2020. That was less than the 5.5% decline of the industry average. And it is worth mentioning that in the US, which is the company's main market, cigarette volumes increased at 0.5%. One of the reasons of this industry lower volumes is that some smokers are switching cigarettes for new products, and the cannibalization is good for companies because usually new category products have larger margins than cigarettes. Anyway, cigarettes are a profitable business with gross margins of approximately 67%. BAT has constantly gained share in each of the last 9 years and currently holds 29% market share in top 40 tobacco markets. Its business basically can be defined as rising value share in developed countries and increased volumes in developing markets. Looking at cigarettes revenues by regions, we see how important the US and Europe's market are. And the tobacco industry is characterized by its huge pricing power. BAT is the leader in pricing, including its core market in the US. And in 2020, the company increased prices by 7% and 1 year before by 9%. The good news of BAT is that every year higher pricing more than offset lower combustible volumes. And that makes the company, and especially the combustible portfolio, very profitable. Last decade, average annual volume was down 2% versus an average annual price increase of more than 6%. And one interesting point to figure out if the company would be able to further increase prices in the future is to look at affordability. And Americans have an excellent affordability for tobacco. So even if the company raises prices further, smokers won't have to do a big economic effort to buy them. One of the reasons of this enormous capacity of the industry to increase prices is because it is an oligopoly with few players who are called big tobacco, and which sold more than 80% of legal cigarettes worldwide. As we have already explained, volumes in cigarettes are decreasing annually, but we can realize that the increase in prices more than offset lower volumes, and that's why the company almost every year increases its revenues. And as I said before, and you can see in this chart, the affordability of US smokers is excellent. We are going to focus now on the US market. It represents 51% of EBIT and 44% of sales in the year 2020. And the US market is a high margin and highly cash generative market. The US is essentially a cigarette market with 87% of BAT's revenues in the country coming from combustibles. In the first half of this year, volume in the combustible portfolio fell more than 4% in the country, but it was more than offset by an increase of almost 13% in cigarette prices, and that allows to an organic revenue growth of more than 8%. The company is well positioned in new categories too, and for example, Vuse, which is its vapor brand, is the second player in the US, and BAT is the third player in modern oral tobacco. We can see that most of the revenues in the US are produced by cigarettes, followed by traditional oral tobacco and vapor. The US, which is the blue color, has been the largest contributor to company's profit from operations growth since 2017, and the business outside the US, which are the rest of the colors, has been roughly flat, calculated in British pounds. In 2017, BAT acquired the remaining 58% of Reynolds they didn't control, and they paid $49 billion, which was more than 26% premium over market prices. It is important to talk about this transaction because it changed the company and the business of BAT. If we focus on valuation, we think they overpaid because the acquisition was made at almost 17 times EV/EBITDA, and they paid the highest end multiples paid in major tobacco industry transactions since 2001. But I have to say that the directors involved in the transactions are not longer in the company. And if we focus on valuation, the acquisition was attractive because it changed the company's business allocation and allowed the firm to become a key player in the high-value US market. The financials of the company also changed. The net debt to EBITDA ratio increased from less than 3 times in 2016 to more than 5 times in 2017. And this high leverage post-acquisition limited flexibility on excess cash returns. So we think as leverage comes down, the possibility of cash return grows. And that's why part of the investment case are future buybacks. The US is one of the most important tobacco markets worldwide. The US tobacco market is expected to reach more than $119 billion by 2025, and it implies an annual growth rate of 1.9%. In the US, nowadays live more than 34 million of smokers, and Americans have a huge interest in alternative nicotine products. The US offers a huge possibility of increasing cigarette prices because it is one of the most affordable tobacco markets worldwide. And VAT has some regulation risks in the US. The US Food and Drug Administration attempted to ban menthol cigarettes, but if it is finally approved, we think it will likely have a modest impact as it happened before in the European Union. At the end of September, the International Trade Commission ordered to ban imports of Philip Morris International IQOS devices, but US IQOS sales are minimal, and for the moment, this measure has nothing to do with VAT heated tobacco brand. And another potential risk could be the increase of federal excise tax proposed in current US budget negotiations. This regulation could result in cigarette prices increasing, but as I said before, fortunately, US affordability is excellent. And the need of compliance with the increasingly regulation is causing even more consolidation in the sector. So legal compliance is expensive and many companies can afford it. So especially the smallest ones which have to exit the market. VAT associates company represents 6% of VAT's net income. And the main associate company is the Indian ITC, where VAT owns almost 30% stake. ITC has a 77% of market share in legal cigarettes market in India. More than 90% of revenues in ITC comes from India, and 75% of profits comes from tobacco. It is an astonishing company, but it suffers headwinds since 2021 with the challenging situation in the country. Its market cap is $39 billion. Barriers of entry are very high in the national tobacco industry, and ITC is well positioned with a monopoly. Now we are going to focus on the non-combustible portfolio, which represent just 12% of sales. It is a high growth segment and a big future opportunity. A non-combustible portfolio has two main segments. One is the traditional oral tobacco, which was less than 5% of 2020 revenues. And on the other hand, new categories, which last year weighted almost 6% of group's revenues. And they include heated tobacco, vapor, and modern oral tobacco. The non-combustible portfolio represented almost 12% of total sales in the first half of this year. And when tobacco is not born, it has lower levels of toxicants for the consumers. And due to its lower risk, these products usually have lower taxes and a more lax regulation. This portfolio has reached more than 16 million of consumers, which implies an annual growth rate of 32% since 2018. And the company's target is to reach 50 million consumers by 2030. The major source of revenues in the non-combustible portfolio are new categories, with half of the revenues of this portfolio, and it is followed by traditional oral tobacco. New categories could be a future opportunity, as it has been, for example, for its peer Philip Morris International. But nowadays, they are not profitable for VAT. They expect to reach the break-even point in 2025. Revenue from new categories increased 43% annualized since 2018, and company nowadays makes 1.4 times more net revenues per customer for new categories than combustibles alone. These are the new categories, brands and devices, and flagship new categories are vapor in the US and heated tobacco in Japan. The percentage of new categories in group's total sales has been increasing in previous years. And gross profit margins are larger in heated tobacco and in modern oral than in factory-made cigarettes. However, as you can see, in vapor are lower. Let's talk about its financials. BAT had a strong operational performance in the challenging 2020 when revenues were down just 0.4%, sorry. If we don't consider the currency movement and other special items, it would have been an increase of 3%, and this number is at the top end of firm's guidance. Profit from operations rose more than 10% last year, with diluted earnings per share increasing 12%, and operating margins were up to almost 39% in 2020 versus a 35% in 2019. It is interesting to know that the company aims to deliver annualized £1 billion in efficiency savings by 2022. And BAT has a very strong cash flow visibility, and last year free cash flow amounted to more than £7 billion. BAT has a good track record of earnings per share growth over the years at constant currencies. And here you can see how constant high operating margins are over the years. Total debt is around £44 billion. BAT rating is BBB+, investment grade and stable outlook. And the net debt EBITDA ratio was 3.3 times last year. That was lower than in 2019, and they expect to be around 3 times by the end of this year. Obviously, the largest increase of debt was produced with Reynolds acquisition, when debt goes from 3 times in 2016 to more than 5 times in 2017. The company targets an average debt maturity of at least 5 years, with no more of 20% debt maturing in a single rolling year. And I want to mention that in the second quarter conference, the management talked about the leveraging and increasing its capital allocation flexibility. So we think the company could do buybacks in coming years. Since Reynolds acquisitions, the company has reduced its net debt EBITDA ratio every year. And the largest amount of debt matures after 2025. And seeing the maturities and with the visibility in cash generation, we think debt is not a big issue for BAT. Current BAT's dividend yield is 7.7%, and if we take into consideration the period since 2010, dividend growth has been 7% annualized. Furthermore, they increased more than 20 years annual dividends, except in 2018 after the Reynolds acquisition. And BAT stated its commitment to dividend payout policy of 65% of adjusted diluted EPS. And as we said before, the leveraging balance sheet rises the prospect of additional cash returns to shareholders. Here are BAT's dividend yields over the years, and the current dividend yield is especially high compared with historical percentage. Dividend per share has been increasing all the years, excluding the year after Reynolds acquisition. And CapEx is not really high in BAT. When the companies bought Reynolds, it increased, but since that year, CapEx is decreasing. BAT has a medium-term guidance of 3 to 5% revenue, a high single-figure EPS growth. Its target is a 65% dividend payout ratio, and they expect from 2 to 3 times net debt EBITDA ratio in the medium to long term. So we could say that the catalysts to reach these targets are accelerating new categories revenues growth, value growth in combustible through pricing mix, and efficiencies. We think VAT is a good opportunity because it is a defensive stock in an uncertain period, and tobacco industry is countercyclical. For example, sales of tobacco companies increased in 2008 crisis. And in this crisis, VAT share fell by 5% versus minus 34% the Dow Jones and minus 31% FTSE. Furthermore, capital requirements to operate the business are low, and the company has very strong cash flow generation capacity, and that's why we consider leverage is not a big issue. Here we can see the good performance of VAT in the 2008 crisis. VAT's valuation is very attractive. According to historical multiples, VAT is cheap, and the company trades at 8.8 times 2021 price to earnings, while the average PE ratio of last decade was 14 times. It trades at a current free cash flow yield of 11%, and significantly, VAT is at its steepest discount versus consumer staples in 20 years. And despite being a leading company in the last 5 years, the stock has lost 42%. If we consider price to sales ratio, the company's valuation is very attractive. And looking at EV/EBITDA ratio, it seems that the momentum is right. Here you can bear out that VAT is trading at the deepest discount versus the consumer staple sectors in 20 years. And here is the stock chart. And before Reynolds' acquisition, the performance was excellent, but after the transaction, the performance has been bad. And as I said before, we think that they overpaid, but now we are buying the company with an attractive valuation and with Reynolds' acquisition already made. We see risks and opportunities of VAT, and let's begin with the risks. Regulatory risk is a fact. If countries raise tobacco taxes, won't be positive. But as I said before, fortunately, the US tobacco has a good affordability. It is possible that growth from new categories would be weaker and they would not reach break-even in 2025. But as we said before, we consider the current valuation isn't taking into account new categories. So for us, this is not the worst risk the company could face. And some analysts have expressed its concern about higher pricing impacting volumes. But as we explained, the affordability in the US is one of the best worldwide. And another risk is illegal tobacco, which represented in 2019 30% of industry's revenues. We see a lot of opportunities too. Cigarette volumes in emerging markets were higher, and in developed countries, they are rising prices. And you have to take into account that the high valuable developed countries represented 75% of VAT's revenues. The company is leading pricing power in the US, where the tobacco affordability is one of the best worldwide. A big opportunity could be smokers switching from cigarettes to new categories, which have higher margins. And as I said before, the company expects break-even for new categories in 2025. They expect to end 2021 with a net debt to EBITDA ratio of 3 times. The leveraging to 2 to 3 times would allow the company a better capital allocation, and we are not ruling out the possibility of future buybacks. Another opportunity is that new regulation could result in even more consolidation of the industry. Due to the high cost of compliance processes, some small companies could have to exit the market. And we think its Indian ITC stake has potential. India is the second largest tobacco market in the world, with 12% of the world's smokers, and Indian population is improving its purchasing power. And a good opportunity could be to leverage its huge commercialization net to take advantage of cannabis legalization momentum in the US. Before ending, let's look at the attractive tobacco industry. Total nicotine industry revenues were around $818 billion, and combustible tobacco represent 86% of them. BAT expects global nicotine revenue pool to grow at an annual rate of more than 5% through 2025 versus the annual average of 3% in the period between 2007 and 2019. Despite lower cigarette volumes globally, industry net revenues rose 25% in the last decade. And one important point is that the number of smokers has been mostly flat since 1990, and there are approximately 1.1 billion smokers worldwide. The gray line is the volume, which is decreasing, but industry revenues are increasing, and as we said before, is mostly due to the higher cigarette prices. Here is the percentage of smokers among population since 1965. And you could appreciate that it has remained stable. The tobacco industry is an oligopoly with few players that are called big tobacco, and through the years, they are capturing considerably more business. The norms regulating the tobacco industry are rising, so compliance is increasingly expensive, and this means that barriers to entry are larger, and it is forcing some players, mostly the small ones, to exit the market, producing a further consolidation. Here is the impressive consolidation of the sector. In 2001, 43% of cigarettes were sold by big tobacco companies, and as you can see, in 2017, it has increased with till almost 81%. According to World Health Organization, next decade, the number of smokers will be similar, around 1.1 billion worldwide. And cigarette volumes are decreasing due to illegal tobacco, further regulation, and switch to alternative products. And in fact, annual global tobacco sales average falling was between -3 to -4%. But pricing power probably would continue to be good in countries where affordability is fine. And it is important to remember that tobacco industry contributes in more than $200 billion to government revenues around the world annually. Nowadays, new categories represent 6% of global volume, and they are expected to represent 10% in 2023. Their future is bright because they are less risky for consumers and tobacco companies receive higher margins, so it is a win-win situation. And this is a big opportunity because there are 68 million of new categories consumer versus 1.1 billion smokers. And the truth is that the cannibalization of cigarettes exists, but it has been profitable for tobacco companies due to its higher margins. And global vapor, for example, or heated tobacco sales are growing exponentially. The industry expects in the next 5 years higher growth in new categories than industry. And this chart is according to Philip Morris, and industry is expected to grow annually at 4%, heated tobacco at 25%, and vapor between 10 and 15%. The tobacco sector has a good track record. For example, as we are going to see in the next following charts, the MSCI World Tobacco rose more than the MSCI World, and the S&P Tobacco CPS has multiplied by 7 times since 1995. From 1900, tobacco industry outperformed the rest of the sectors in the US, and the tobacco sector has the highest margin across European staples. The MSCI World Tobacco rose more than 15% compared to MSCI World from 2006. The S&P Tobacco CPS has multiplied by 7 times since 1995. Tobacco industry, which is the first dark blue line, was the best US performing industry since 1900. And the current tobacco sector valuation is also very attractive. The S&P Tobacco Index is at similar levels than in 1996 and barely up from 2008 crisis. The MSCI World PE rate is much higher than the one of the MSCI World Tobacco. And if we focus on the European tobacco sector, the forward PE is half the one achieved in 2016. And the dividend yield of tobacco sector tripled the average one of the MSCI World. Here is the PE ratio of the S&P Tobacco. The dividend yield of tobacco companies is higher, and as we said before, the valuation is more attractive than the MSCI World. So for concluding, British American Tobacco is the world's largest international tobacco company by revenues, with a market share of 22% excluding China. It owns 6 of the most sold cigarette brands worldwide and is the leader in pricing power in cigarettes. It has a very good track record, delivering 10% adjusted diluted EPS at constant rates, CAGR over the last 10 years. And one key aspect of BAT's investment case is its exposure to the US market, which represents 51% of the company's EBIT, and the US is a very attractive and profitable tobacco market, and US tobacco consumers have a high affordability. In our view, BAT is a defensive stock, which offers strong cash flow visibility due to the company's solid market positioning, and also because of the high entry barriers and oligopolistic condition of the tobacco industry. Its valuation is also very attractive. The stocks trade at 8.8 times its full year estimated earnings. BAT is at its deepest discount versus staples in 20 years. And on top of that, it offers a 7.7% dividend yield, which is one of the highest yields in the FTSE index. So thank you very much. I hope you have enjoyed the presentation. And John, maybe you have some questions.
Well, thank you very much, Marta, for the presentation here. Could you talk a little bit about the valuation of the company as it compares to other major tobacco companies? It sounds like it's at a discount to the sector as well.
Yes, for example, in our portfolio, we have Philip Morris International, BAT, and Altria. We can compare, for example, Altria and BAT because they have a high exposure to the US market. Altria has practically all the exposure to the US market, and for BAT, the exposure is at 51% of its EBIT. But Philip Morris International, we think, has more quality. It has more exposure to new categories, and its brand of new categories, which is IQOS, is amazing. So it is more expensive. Philip Morris International is more expensive than BAT and Altria, but we think it's another play with another quality.
Understood. And could you talk a little bit more about the markets where you see volume growth for the company? Is that mainly India, or are there other major markets as well?
So right now in the industry, volumes are just increasing in emerging markets, basically. So in developed countries, you have volumes decreasing, but revenues are increasing because of the pricing mix. So the exposure of revenues of BAT for emerging markets is 25% approximately in revenues. But the most important market is the US. And in the US, last year, volumes increased at 0.5%. So it's not a big increase, but they are increasing in the US.
Why is the percentage of illegal tobacco going up, it seems? Is that a function of higher taxes or other factors?
Yes, higher taxes are an issue, but for example, in the US, you have the possibility to increase prices because the affordability is very good. If I can remember well, the elasticity, for example, in the US market, which is the main market for BAT, is 0.38%. So for every 10% that they increase cigarette prices, they lost just less than 4% of demand. So.
And illegal tobacco, is that a big problem? And do you think it will grow in the future as an issue for the industry?
Yes, in emerging markets, I think yes. For example, you can see in Brazil, that is the second VAT market, but it made just 5% in revenues, that they are having problems with illegal tobacco. But it's more an issue of emerging markets. But I said before, the exposure of VAT to emerging markets is just 25% of its revenues, and in profits is less than 25%.
As leverage comes down, how do you view the mix between the dividend and the buybacks, potential buyback?
So the dividend right now is 7.7%. So it is high. And if you see in the last decade, the average was a 7%. So maybe they are going to do buybacks in the coming years.
I was asking about the right mix in the future between dividends and buybacks, in your view.
Okay, the dividend yield right now is at 7.7%, so it is high. And if you see the last decade, the average of the dividend was at 7%. So we think the dividend is already high, but they can increase or do buybacks in coming years due to this, the leveraging of the balance sheet. And as they said in the second quarter conference, maybe they can do it in the coming years. Let's see.
Okay, wonderful. Well, Marta, thank you so much. Those are my questions. I would just encourage you, feel free to follow up as well with any further thoughts or questions. We're always happy to facilitate an introduction. It's been a real pleasure having you with us. Thank you so much for taking the time to share this investment thesis.
Thanks a lot, John. It was a pleasure for us.
Great. Goodbye for now.
Goodbye.